Well, for more on how the news out of Europe is affecting world markets, I want to bring in Neel Kashkari. He's the Pimco head of global equities and formerly served as the Assistant Secretary of the Treasury. Neel, it is great to have you back on the program and seeing what's happened over the weekend in France and even what is going on in Holland. Does it change the landscape for you in Europe?
Well, it does. It's adding uncertainty to what Chairman Bernanke has already called an unusually uncertain period. So it's not just elections in France. It's elections in Germany, elections in Ireland, elections in Greece. Each of these adds political uncertainty to an already uncertain environment. Just take France for a second. We know that President Sarkozy is closely aligned with Angela Merkel. If he's reelected, we have a lot of confidence in what type of policy measures they're going to continue to pursue to deal with the European crisis. If Hollande becomes president, it's a lot less clear. He said he wants to pursue less austerity and more growth. More growth is certainly good, but which policies as a governing president would he actually implement to pursue more growth and to try to deal with the European sovereign debt situation? So if there's a new president in France, it's going to take markets time to understand exactly how that new president will govern. And until we see that and know that, it's going to increase uncertainty and people are going to be cautious.
But Neel, it's not as if the markets in Europe, or even for the world for that matter, have been very stable, even with Sarkozy in place and knowing what policies he's after.
No, you're exactly right. Markets are swinging from euphoria to euphoria, back to fear. Right now, markets are somewhere swinging back in the fear direction. And I think that this will increase the amplitude of those swings and maybe even the frequency of those swings back and forth. Right now, everything we can do to try to stabilize the market and bring confidence back would be a good thing. Right now, there's a vicious cycle of fear leading to less risk-taking, leading to more fear. We need to break that vicious cycle.
So, Neel, how do you hedge against this fear? I mean, are you going to pare back any of your European holdings or European plays?
Well, we're being very selective in the names that we're buying. We've analyzed if there is a fragmentation of Europe or a major shock out of Europe, how will it propagate through the global economy? There are a handful of transmission channels, the banking channel, the sovereign bond market, corporate finance channels, trade channels. We're able to select individual securities based in Europe that we think have less direct exposure to these various transmission channels. So, for example, Ensco is a name, an oil company headquartered in Europe, but has less direct exposure to the European situation.
Well, we are back with Neel Kashkari. He's the head of global equities at Pimco. And Neel, you just came back from Asia, and we had some news out overnight about China and its manufacturing sector contracting yet again for the sixth straight month. So what did you get out of Asia? What's your impression? Well,
we're still cautiously optimistic on Asia. We are not forecasting a hard landing in Asia. We think China is going to generate about 7.5% real GDP growth this year, which is still very strong growth for such a large economy. The last several years, Asian policymakers and emerging market policymakers have really led the rest of the world with their very aggressive policy actions, both fiscal and monetary policy. They are more constrained now. Inflation is creeping up. They're very sensitive to oil prices. They're going to have less room to move. And so we don't expect Asia to lead the world in policy response. We now expect them to follow the West in terms of a policy response for the near future.
So does that mean that you've pared down some of your China plays then, or have you actually doubled down?
Well, I don't think in either case we've done either. We are still selectively finding names in Asia, in emerging markets that we like. But once again, we're buying companies on an individual name-by-name basis, not only because of the country that they're in, but much more importantly, which country they're selling into, where they're producing their goods.
Well, then what's the holding that you have that you're most comfortable with that actually would hedge against a China slowdown?
Hedging against the China slowdown? Well, take Samsung as an example. It's not a Chinese company, it's obviously a Korean company, but it's a big Asian exporter to the rest of the world. It's not so tied to China as much as it's tied to countries in America, countries in the West that are selling into. We're looking at companies, where are they selling into much more than where are they producing their goods or where they're headquartered. In China, other names that we like are AIA, which is a big insurance company in China, one of our top holdings. There's large domestic growth opportunities for it across the Pan-Asia region. So again, we're just being very selective, but we are finding names that we like in China at today's prices.
Okay, Neel, I want to bring it back here to the U.S. because I know you wrote a recent report about corporate profit margins, and boy, have we seen quite a bit of that in the earnings reports so far. I mean, I know you've mentioned, look, if this equity rally is going to continue, we need to see profit margins stay the same or move higher, improve. So what makes you think that they will keep at this level?
Well, we think so because we've looked at what are the different catalysts that could push margins to revert back down to the mean. And I've identified 5 in that piece. Labor costs. With unemployment at 8.2%, we're not seeing cost pressures from labor anytime soon. A recession in the U.S. Again, we're forecasting new normal type 2% real GDP growth. Not fast enough to bring down unemployment, but also not a recession.
Okay.
Dollar strengthening. We're not forecasting the dollar going up. Cost of capital increasing. We think the Fed is going to keep rates low until end of 2014. And finally, corporate taxes. Republicans and Democrats, no one is seriously talking about raising corporate tax rates right now.
Yeah.
So each of those 5 measures suggest that corporate margins should stay high for the near future.
But Neel, of those 5, and if we can bring that chart up again, of those 5, which is, though, the biggest risk to bringing down corporate profit margins?
I would say recession, which is if there were an oil price spike that could tip the economy, the global economy, into a recession. If there were a Eurozone fragmentation, that could also tip the global economy into a recession. Or if there's a very hard landing in the emerging markets, which again, we're not forecasting. Any of those factors are big downside risks that could tip the economy into a recession, and that would certainly affect corporate margins.
Okay, and in that case then, Neel, I mean, if you were to look at, your U.S. holdings, I mean, which ones would sort of, again, hedge against the risk of falling corporate margins?
Well, I think that, let me give you 2 more names that we like, but they're very much tied to the global economy. Take John Deere, one of our top holdings. John Deere is obviously a world-class American company, but we see John Deere as a way of playing emerging market growth.
Okay.
So if it were a European shock, but John Deere is still able to sell into emerging markets, which are demanding more protein, need massive agricultural investment, we think John Deere should be very well positioned.
You see,
generally,
But Neel, I'm a bit confused because because you take Samsung because of its selling power into the West, and then you take Deere because of its selling power into emerging markets. So how do you balance that?
Well, we're not buying. There's no one stock that is going to be resilient, no matter what shock you put out there. Certain stocks are more resilient and less resilient to certain shocks. And so we're trying to pair these up and figure out, look at the portfolio as a whole,
okay,
and make sure the portfolio as a whole is not have too much exposure to any one risk.
Okay, all right, that makes sense to me. Neel, thank you so much.